What's up, traders? In today's video, I want to walk through the stochastic indicator and the way that I use it versus the way that a lot of, well, I would say beginning traders might use it. So we've talked about this some in prior videos, but I want to really dig into it. So what we're going to learn today is what the stochastic indicator is. We're going to talk about the way that it's calculated. I'm not going to go into the very nitty-gritty details, but just the basics. And then we're going to talk about divergence and trend, and how when you combine all of these things together, you can find some great trading opportunities. So let's get started. What you have here is a chart of the NASDAQ futures. There's a really fast time frame. It's a 133 tick. So for those of you who are not familiar with tick charts, all this is the number of orders that flow through the market. So every 133, or every bar represents 133 orders, not contracts, okay? That would be a volume chart, but it represents 133 orders. And then the other things that you see on here, you'll see these arrows. Now I'm going to talk about these arrows in a while, but for now just know that they are derived from the stochastic. Okay, let's dig into the stochastic indicator real quick. So that's what this guy is here, and I just realized these lines are really hard to see on the video, so let me change the color of those. I'll be right back. Alright, much better. Okay, so you have a few lines on this chart. You have a lower boundary white line, and what that is called is your oversold line. So if stochastic comes below 20, and you can change these numbers, but the defaults are 20 and 80. So if stochastic comes below 20, then the market is said to be oversold. If stochastic goes above 80, again, the market is said to be overbought. And if it's overbought, you expect prices to come down. If it's oversold, you expect prices to go up. And then you have these two little squiggly lines. So you have this orange line, which is called your percent K. Percent K is the most important line in your stochastic. It is the one that has all of the formulas in it. And these formulas are based on each specific bar. And it measures the high and the low, the open and close, and then where does price close in relation to the low. So let me blow this chart up a little bit and we'll dig into one. Let's look at this bar right here. So at the close of this bar, my stochastic went from 31.53 to 26.51. It was a down red bar, but stochastic did not move that much at the close. Why? Well, my close of this candle was 55.50. The low was 55. It didn't close on the low. It closed 2 ticks off the low. In addition, it had a high that was relatively far apart from the close. Okay, let's look at this candle right here. At the close of this candle, my stochastic goes from 5.53 to 31. That's a big move, right? In comparison to this one, which only moves 5 points. Well, you can see why. your open was down here and your close was up here, and the bar closed at the high. Now, if we look at this bar, same type of a deal. It didn't close at the low. It closed near the low, but not at the low, right? So that's just the basic of how it's calculated. It goes into a little more detail, but I'm not going to go into that in this video. Okay, and then you have your %D, which is this blue line, and all that is, it's just a moving average of K. So, frankly, in my personal opinion, %D means Zippo. So, I'm going to remove it. And to do that, just make it a 1. Makes it a 1 period moving average, which is going to be equal to K. And there we go. Okay, so how do people use stochastic? Well, unfortunately, many beginners use it wrong. Stochastic is an indicator that when using correctly can seriously blow up your account. And a lot of traders will use, if stochastic is overbought, they'll look for a counter trend trade for a short. So you'd be looking for shorts all up in here. Well, the issue is, as you can see, stochastic can stay overbought for a long time. Now, the best use of stochastic is to find a way to identify the trend, and then take that trend and wait for stochastic to go to the opposite extreme and take a trade. So, for example, right here we know that we're making higher highs and higher lows. And if we look at the structure, we can see our zigzag pattern right? Something like that, right? Now I missed a few in here, but that's okay. So you can see your higher high, higher low, higher high, higher low, higher high. Now, in this specific higher high, higher low formation, price never came back to test it. However, in this one, it did. Right? Here's your area. Stochastic comes down, and it goes oversold right here. So if you want your highest probability trade, it's right here. This would have been a spot, and then again here. So me personally, I would have taken a trade here and then here. Now, let's look at some more examples. Now, this indicator down here at the bottom, this is just a way that I identify trend off of a higher time frame. So if I want to wait specifically just for this to have to line up with price, I wouldn't be taking a trade back here because I have a red and a green. But right here I get both of them green. So then I could just wait for actually right here I get both green. I could wait for stochastic to become oversold, which is right here, take a trade, didn't work out, then I could take another one here. And then this one works out. Make sense? Simple in concept, but again, you have to build rules around it so you can test it and do the same thing over and over. All right, finally, let's talk about divergence. Let me remove all these lines here. All right. Divergence. All divergence is when price makes a low, you can record that low, And then if price makes a lower low or an equal or lower low, while stochastic makes a higher low, you have divergence. All right? Let me repeat that. If you look at the low of price, price makes an equal or lower low, while stochastic makes a higher low, you have divergence. What this is telling you is while price is going lower, the momentum in the move is not as strong, suggesting possibly that there could be a reversal. Again, be careful looking for divergence against the trend. You see all these arrows, gang? All these arrows are divergence. Now there's a bunch of them because I'm on a micro time frame. But you can see how you could get yourself in trouble. So instead, look at structure and wait for divergence in structure. Here's a spot, and then here's a spot. Or use this. You can use a trend indicator like mine and wait for divergence with the trend right here. See? It would have been a nice trade. And if we wait, we'll keep going. I'll show you the downside. You would have had a handful of arrows in here that would not have worked out. But keep in mind, gang, if you caught that first trade back here, I always wait for what I call a reset before I take another one. So I wouldn't have been taking or even looking for any trades in here. All right. So now let's wait till we have both indicators red. Here you go. Both of them are red. Not on this arrow, they're not. So I could not take a trade here, but right here. Both are red. And there you go. You see, it makes trading much simpler when you have these parameters. So let's take a look at a higher time frame chart. I have a Forex chart here we can just take a quick look at. And this one I actually have a structure indicator on the chart. And so what I'm looking for here is when I have structure that aligns with divergence. So here's my structure right here. Here's my divergence arrow. Boom. And this was a trade that just happened on, I guess this was Thursday, August 30th. And same thing to the long side. I have my structure, I have my divergence, and boom. Right? Simple. All right, gang, just thought I'd put that together. Go to the website, guys. Get signed up for my email list. I've got some great things coming. I know it's been a long time, but I've been working like a dog to get a lot of this stuff ironed out and put together, and I'm going to have some great stuff for y'all. So go to the website, tradebythenumbers.com, and get on the email list. It doesn't cost a thing. All right, catch you later.